Hey everybody, this is Jose here. We're about to start, 30 seconds to go. This is a sound check. Please go ahead, confirm with a quick message that you hear my voice. That would be appreciated because we're about to begin. Thank you so much. Just a quick hello would do. As always, you guys know the routine, isn't it? Very nice. Thank you so much, Jaime. We just reached the starting time for the session, isn't it? Top of the hour. So let me introduce the session formally so we can begin. Hello, everybody. How are you? Happy Sunday. Hopefully everything is going well on your end. In these crazy times where still many countries are in lockdown and so on, and I guess that some of you are keeping positive and utilizing wise time at home to sharpen your skills. And today we are getting together to sharpen the skills in it. It's a sharpening session. So that's the purpose of today. Today is May 10. I didn't say it. And my name is Jose Blasco. I will be your guide. And as the title of this session suggests, today the idea is to go over Q&A that often leads into topics that we get deep into from an educational point of view. And this is what we do. We love to do this when it's weekend time, meaning that the markets are closed and trades cannot be taken, but certainly we can use this time to fine-tune how we trade, sharpen our skills. Before we start, disclaimers: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive from using our products. That is the disclaimer, and therefore the session is now officially introduced. And here is the beautiful TradeStation platform. We're going to be looking at TradeStation, TradingView. We're going to be looking at the markets, different assets, and also we have a series of questions. Okay, so before we start, a quick look at the chat box to get organized here. Gary, how are you? Praveen, a pleasure to have you. Jaime, how are you, Jaime? Vino, very nice. Alan, good to go. Love it. Marcus, how are you? Marcus, good to see you. Fun week last week, isn't it? Very nice. Okay, so let's begin. So again, today the topic it's Q&A, and I have a collection of questions which are very good actually. We do that. We do this often. Okay, this is nothing new. We many times during the sharpening sessions we spend time to go through specific content which could be new or could be addressed in a deeper manner. Sometimes we take a step back and we go over questions, and this is kind of like my favorite type of session, to be honest, because the questions are coming from you. The questions are coming from your hard work, where you have been attending the sessions that we do. You have been putting practice into it, and then you get to find certain situations in the marketplace, and you get to ask about it. And this is very enriching for everybody, including for myself as your instructor, because it also helps me to do a better job each time when it comes to delivering the content for you guys, because I get to understand better your needs. Because even though one day in the past I was learning how to trade myself, well, that was a long time ago, and when years and decades go through, there are certain things that we forget. Okay, so in this sense, it's very healthy for me to put myself in your shoes the most I can, and get to answer those questions which are really key. Okay. So keep doing that. Please. Also, when you send emails to us, and it's easy to answer questions, so then normally we just respond in the email, so you have no waiting time if you wish. But many questions require much more than an email and are rich enough in the sense that when shared with the community, they actually help more traders, not only the person who phrased the question. Okay. So let's begin. So the first question I have here is says that today I was watching the sharpening webinar on futures. In the webinar, you were referring to a website called barcharts.com. And following the webinar, I was looking for point value, but I couldn't see it. Is it data that is not used now, or it is customized data that you have to pay for? Okay, so let's take a look at that. Okay, let's take a look at that. So barcharts.com, it's certainly a website which we use often. We use it often because when it comes to futures, it has this very nice kind of summary of the key 8 groups available in futures: currencies, energies, financials, grains, indices, meats, metals, and softs. Okay, and when you load this website, basically it allows you to see all the markets that are available in those different future exchanges. But apart from that, also get to have an understanding of their characteristics, because when trading futures, for the ones of you that don't know, each futures contract has a different size and therefore a different impact when it comes to the amount of money you make or you lose when the market moves your way or against you. It's not the same to buy a contract on the S&P compared to buying a contract on crude oil. Putting on the side that one market may be more volatile than the other one, the amount of money you make or lose per point, per tick, it's different because the contract specifications are different. So we use barcharts.com very often because of that reason, because it's an easy way to consult everything you need to know about futures before you place an order. And normally when you see me use it in the sessions, normally it has to do with commodities in general, for example, gold, oil. So I would do something like this. I would come into gold, okay, and then I would pay attention to the top letter here on the top, GCM20, and that letter refers to the expiration date of the contract, which we want it to coincide with the contract with the greatest volume and open interest, okay, which you can see here is the M. Okay, so normally you can see it just by looking on the top. Not always. There are times where the letter on the top does not coincide with the bottom, and that's why you gotta double check both places. Normally it does. Okay. So yeah, so in other words, you see me use this website many times because of this. Okay, but now coming back to the question concerning the points. Okay, well, the point value, it's right here. Okay, right there. Okay, this column represents the point values for each of those contracts. Okay, so in one hand, it's an easy answer I'm giving you here. Here's the point value. That's it. This is the answer to your question. But at the same time, I want to go a little deeper into that because there is more I would like to explain when it comes to point values. Okay, so here is the point value in this case for the energies. Okay, so if I keep switching from tab to tab, the point value is the column on the right, as you can see. Okay, so now you know where to find the point value. Okay, so that was easy. But again, why is it that I wanted to discuss this with you? Well, because when you look at markets, for example, like the indices, okay, let's use the S&P for instance, okay, and you see a point value is $50, okay, everybody understand that in the case of the S&P, 1 point, okay, 1 point equals 1, okay, 1 point equals 1. So in other words, if I click on E-mini S&P 500, we get to see that the current value of the S&P is 2,928.5. Okay, so if you think of this value, okay, and you think about this market going from 2,928.5 to 2,929.5, so this market went up by 1, which is 1 point, and therefore you would have made $50 if you were long. You would have lost $50 if you were short, because it's 1 point. Okay, and I think it's very easy to understand in the case of markets such as the S&P. But, and again, up to this point, it's all very obvious, I would say. But when you look at the currencies, okay, for example, if I look at the Euro Forex, okay, so if you look at the Euro Forex, okay, and the current price for the Euro Forex is 1.0850. Okay, that was the closing price on Friday, right? So, so if I ask you the question, so what is 1 point now? So now is when different traders around the world may have different ways on how to look at it. I mean, mathematically speaking, 1 point means going from 1.0850 to 2.0850. That's 1 point. It's plus 1. The same math we did with the S&P a second ago, right? But I mean, have you ever seen the euro? Okay, for the ones of you trading the euro or currencies, have you ever seen the euro double its value? Have you ever seen a currency double its value anytime? Well, could that happen? Of course, it could happen. Is it likely to happen? Well, I would say no, especially between when we talk about currencies such as the euro, the dollar, the yen, currencies which are so relevant for worldwide economies. If they were to double their values, it would mean that we are facing a complete, let's call it a complete abnormal situation for such economies, or completely different monetary policies managed by those central banks trying to achieve who knows what kind of a goal, allowing the currencies to move to such crazy levels. That would not be something easy to be seen, right? Now, technically speaking, one point is that, and technically speaking, if you were to buy a contract of the euro and it was to double the value, so what it says here is that for the euro, okay, the E6, okay, so you would make $125,000, okay, so it's a very large point value, $125,000 instead of $50 like the S&P. But the reason why is because that point, okay, the term point, which is one, really in the case of currencies don't make much sense. Mathematically 100% sense. That's why a point value is 125K. No questions about this. But it is common, and this was going to be my point, it is common among futures traders, especially traders coming from the floor, if you wish, okay? Traders that started their trading before markets were electronic. It is quite common to hear them talk about points as zero point 0.1 instead of 1, okay? Even though a point is 1, mathematically speaking, but it is very common to hear that term where, yeah, the euro move a point today, and that means zero point 0.1, because there's no way the euro would move 1 point in one day unless the world went crazy, okay? So that was my little additional comment there, just for you to know, guys, where to find the point value, but also the meaning of point, which again, mathematically speaking, is 1, and this is the best way to think of points, to be honest. But also, it may be expressed in other ways depending on the trader you are talking to. Okay. Okay. How are you, Agus? Good to see you. Yeah, thank you very much for that, Marcus. Sandeep, how are you? Akmar, nice to see you. Nice to have you connect from with us from Indonesia. Paul, hi Jose. Question on FX. If you have time, please. Do you have a rule for max pip risk? Normally, I trade 240-21 minute time frames. Paul, let me take your question very quickly before I jump into the other questions I had, because it seems to me a quite easy answer there. I just want to make sure I understand your question. So a maximum pip risk, you mean that apart from having a percent risk in your account, let's call it 1%, 2%, 1% risk per trade, for example, you are saying that apart from that, you're saying not to take a trade if the size of a UFO happens to be more than X amount of pips. For example, you have a maximum pip risk of 40 pips, and if you find a UFO of 20, then you'll take the trade. But if the UFO is 50, which is more than 40, then you would pass. Is that your question, Paul? Is that what you are asking about? Give me an answer to that, if that's okay, and then that way I'll be able to provide a proper answer, because that's what I kind of understood from your comment. Okay, and in the meantime, I'm scrolling my screen. Okay, yes, Paul. So that is correct. Okay, so yeah, the answer is I don't have a rule for that. I don't have a rule for that, because the reality is that the size of the UFOs, okay, the size of the UFOs directly depends on the volatility conditions in the marketplace. So if you are dealing with a market, you know what? Maybe we can take a look and you'll see. Okay, so let's for example, let's look at just to change asset, the SPY. That's an ETF, right? So if I look at the S&P ETF in a daily time frame, okay, and I look at this time, okay, this time, December 19, compared to this time, okay, I should see a completely different size UFOs given the different volatility conditions. Okay, so if you look at UFOs at that moment in time, you got 300 to 313, so that's $13 UFO, 321 to 339. This is like, let's call it $20 UFO. So 13, $20 UFO. If you look at the buy side, this UFO here is, let me bring the right values. Yeah, so like let's call it 218 to 229. Okay, so we got 10, we got 15, we got 20. So let's say the average is let's call it 15. Okay, so as an average, you got $15 UFOs in current times in the S&P given the current level of volatility. Okay, but what if we go back in time and we look at the UFOs available at that time in November or December last year? Okay, so let's take a look. So what would happen to those UFOs now? Okay, what would happen? So now your UFOs were 320 to 315, 37 to 312. Okay, so this is a $3 UFO. This is a $7 UFO. The one below 304 to 301, $3 UFO. The one below 301 to 299, that is another $3 UFO. So let's call it $3 to $5 would be the average size of those UFOs. In other words, my point was that the depth, the size, the vertical distance, okay, that you find in those UFOs directly depends on the current level of volatility. And this is something that we cannot change. So if you were to make yourself a rule, which I'm not saying is not valid, but I'm just saying that to me is not that practical, because if you make yourself a rule that says, hey, if the UFOs are more than X amount of pips or X amount of dollars in this case, so then I will not take the trade. Well, then basically what you just said is that, okay, during volatile periods, I will not trade. And certainly volatile periods may be challenging in the sense of especially human emotions, because you may get multiple winners in a row, you may get multiple losses in a row. Everything happens quickly. So unless you are a seasoned trader and you manage your emotions properly, it may be challenging somehow. But at the same time, I understand that no matter where we are, okay, all of you in the group here may be at a different level when it comes to how experienced you are in trading. But no matter where you are in that process, I am guessing, and I think I would think correctly if I say that all of you are in the process or targeting as a goal to become one of those very experienced, very seasoned traders. No one is here to take one trade a year and that's it, I guess. So the idea is that you want to know and learn and be able to not only navigate safely volatile periods, but on top of that, profit from it. So having such rule, Paul, would certainly limit you in that way. Okay, so I would suggest that if I'm not sure if the reason for your question was volatility concerns, okay, but I would suggest that if the reason for your question is coming from volatility concerns, then what you could do is in certain periods of volatility, then what you could do is to change your risk management rule to maybe, let's say your rule is to risk 1% per trade, then you move that rule down to risking 0.5% per trade until the markets go back to, let's call it, a normal level of volatility instead of a very high level of volatility. And therefore you continue doing your trades, you have less risk per trade because you have reduced your size. You are still exposed to the markets. You will be less impacted by emotions because the size of your trades is less. And also the moves in volatile markets are more. So even though your trades are with less size, with bigger moves and less size, you should end up with profits, which, let's say, in a simplistic fashion, I will say they may be equivalent to a normal condition with a normal size. Okay, and in this sense, you remain active in the markets, which I guess is probably what we're looking for, to find a balance between being active, being profitable, being consistent, being safe. Okay, so I guess that's the origin of your question. So long answer there, but I think it's important. Jose, continuing from the Tuesday session, can you show us how to trade a stock if the market can only go long and no option trading is available, such as in the Indonesian market? Yes, absolutely, Agus. What about you? You tell me 2 or 3 stocks in the Indonesian markets that you like, and then I will take a look at that. Okay, and it'll be a good experience for you, but also for the ones of you not trading international markets. I think it's going to be a great experience as well. Well, options in Indonesian markets are not what I would call liquid. Okay, so with Indonesian markets, there is a lot of limitations, and that's probably the reason for Ago's question, Ahmed. Okay, Paul, it's more from when a few UFOs are stacked together. That's what I. Okay, I get your point. I get your point. I totally get you. So I went very far into a long comment related to your question, and in the end, I was maybe overthinking a little bit. We need to add a button on YouTube, which if you see me go out in a totally different direction, you should be able to press a button and YouTube beeps on my end or something like that. That would be a nice feature to add. Anyway, jokes on the side. Back to your question, Paul. So the challenge of having multiple UFOs overlapping each other, that you need to treat like a big fat group UFO. The challenge of that is that the challenge is not that it places your stuff very far away, and that's more risk. Pip wise. The challenge is that your safety target is also further away. And we know that the further away your safety target is, or in general, the further away your targets are, the more difficult or the less likely you will reach those targets. So the purpose of the safety target is to remove the risk of the trade quickly, which is a great feeling for a trader. And certainly removing the risk of a trade is something that is it's powerful for traders, because now it opens the door to take more trades in parallel, instead of being stuck in a trade to see what happened until the end, because you already got too much risk in one trade and you cannot add more trades, right? So the safety target role is quite powerful. But at the same time, you are right, Paul. If you got too many UFOs grouped together, next thing you know, the total distance is too much, and next thing you know, your safety target is too far. So the safety target is basically acting like an intermediate target on the way to the final target, instead of providing that safety protection of removing the risk of the trade quickly. Okay? So I get your concern, and I wanted to phrase this so everybody follows your rationale. So that's a very smart question. And to be honest, the way I do it, and this may be because I've done it many times, and it's kind of like I'm kind of used to it, if you wish, to do it in this way, and it's good enough for me. But at the same time, the way I do it is not 100% objective the way I believe you are demanding. Okay, so the way I do it is basically I use my experience. Okay, and if I see that safety target to be a bit too far, then automatically I decide to not to take the trade. But the question in the back of your mind is probably, so, but what is it a bit too far, right? So again, in my case, I'm using that experience. Okay, and many times it has to do with so if I'm taking a trade on a daily time frame and I see my safety target is below the low of the prior day, for example, or things like that, so I would be like, okay, so to reach my safety target, I need the euro to move my way all the way a whole one day to reach there. So when you see things like that, really, it's kind of making you feel, wow, I do need to be right for a very, very, very long time to be in safety mode. And then the safety aspect of the trade is gone, right? So now I'm doing this by basically using my eyes, because I'm very, very much used to it. But if I was to provide you a different way on how to do it, which is more mechanical, and also adapted to volatility conditions, okay, what I would suggest you do is to load an indicator. Okay, so you can load um, the average true range. Okay, so I'm just gonna type here true range, average true range. Okay, and here you can see that the average true range of the euro at this moment in time is 92 pips in a daily time frame. Of course, the average true range for the 4-hour time frame, it's 29 pips. The average true range, not there, right here we go. The average true range for the 60-minute time frame, it's 15 pips, right? So in a perfect world, okay, you would want your safety target to be far away from the entry by less than these values. Okay, because this is the average movement that you get in a one candle on the climate time frame. So in other words, if you give yourself that amount of room, Okay, you are basically giving yourself your trades one candle of time, or another way to say that is one candle of chance to reach a safety target based on what the climate suggests should happen, based on the average movement of that currency, which is the ATR. And this could be something that makes sense, okay? And this could be a good reference for you, Paul. But I do want to add a couple more comments on top of this, okay? And it's kind of like the reason why, in the end, I do it visually, even though I'm sure you can come up with a specific set of rules to do it with the ATR. But basically, the problem I have is that when we are looking at the euro using the 60 and 8 combination, okay, when you are doing short-term intraday trading with the euro, well, let's pretend we are doing a shorting opportunity, and we are using a stop, and to use a stop, we add 2 pips plus 5. So that's a total of 7, right? So now, if I add 7 pips, just to make sure I am adapted to the decentralized nature of the forex markets, the fact that different brokers got different price points, etc., which we should do that. Okay, but the daily ATR is 15. Just notice that just by adding this breathing space, I have already consumed half of the ATR. Okay, that by nature makes my intraday trades to be less efficient compared to the trades that I would take using a daily time frame. And this, by the way, is what it is, because Forex is a decentralized market, and that is what it is. Okay, and I will 100% understand if some of you decide, hey, wait a minute, when I deal with the euro short-term intraday, I will use the euro futures, where I don't need to do +7, I only do +1, right? And when I deal with the euro for a longer term, instead of dealing with contracts that may expire, which is futures, I will deal with spot forex, and on top of that, I may get paid swaps. Okay, so I would certainly understand you doing that. Okay, and certainly that would be a very smart approach. But again, back to your question, Paul. Notice how the ATR in a daily time frame would be very, very problematic, if you wish, because basically it doesn't tell you much about where the safety target should be, because already you are using 7 on the breathing space, where on the daily time frame, okay, I would even say that 92 is way too much for the safety target, because basically that means that you want that market to move traveling in your direction for a full one day, full 24 hours. You know how many things could happen in 24 hours in the market? How many crazy things could happen, crazy news, crazy events, economical reports, and many things that could go ahead and turn around the climate, even though statistics suggest whatever could happen, isn't it? Statistics is statistics. It's not a certainty. So in other words, what would I do? Well, if I was to use a rule based on ATR, I would take this number and maybe divide it by 3 or something like that, and give myself that maximum value, Paul. If I was to use the 60-minute time frame, okay, I would go for the full ATR, or maybe even more, maybe like 20 pips or something like that, because again, it's you cannot have an equivalency time frame to time frame, given the decentralized nature of forex and the fact that you need to add breathing space. Okay, so that would be the way to approach it. The beauty of approaching it this way is that your ATR, as you can see, changes through time. So your ATR is adapted to volatility. So when the markets are less volatile, it would force you to have safety targets closer. When the markets are more volatile, it would allow you to have safety targets further away. So it's certainly a smart way to do it. But again, you will need to do adjustments depending on the time frames that you are going to use, given the decentralized nature of Forex. Okay, so this would be a little bit of homework for you to do. A little bit of back testing would be certainly helpful to have you understand, what works best for you, what makes sense, and so on. Okay, so I don't have a specific rule, and I could share specific figures with you, but you could certainly develop your rule based on this idea, which would make a lot of sense. Okay. Okay. Absolutely. Thank you for that, Paul. My pleasure. How are you, Roy? Good to see you. Okay, Agus, I will now jump into the next question I had in the list, and then I'll go back to you, Agus, and look at those 3 particular Indonesian stocks. Okay, and we'll make a plan for that. Okay. Osman, how are you? Ray, good to see you. Very good. Nice, everybody. So let's go for it. Next question that I had in my list, and then we'll go back to look at Indonesian markets. Okay. So the next question has to do with an options trade. Okay, and this is a very special situation for us to comment because in trading options, okay, there are two sides of the equation, if you wish. There is the theoretical way to understand options, the way options are described in the books, okay, which, by the way, it's correct, okay. But then there is also the real world situations when trading options, which sometimes divert majorly from what the reality is from a theoretical point of view until options expire. And then everybody goes back to what mathematics suggests. But before that, there may be divergences which are very, very, very problematic. Okay, so we need to talk about this. Okay, and this has to do with the following question. So listen carefully out there, options traders. Okay. Okay, so my plan for Apple. So this is a trade on Apple. So it was using weekly options, and the trade was an iron butterfly. Okay, so for the ones of you that are not familiar with the iron butterflies, because normally in the sessions I do iron condors, isn't it? So in an iron condor, you buy a call above, you sell a call below, and then much below, you sell a put, and then you buy a put. Okay, that would be an iron condor. Okay, it's common in options trading to call the short put and the short call the body, and call the long call here and the long put there. Okay, those two together. Okay, if you were to attach them like that, it's very common to call them the wings. Okay, so you got the body and the wing, and that's an iron condor. Okay, but another type of bird, if you wish, instead of a condor, would be a butterfly. Okay, well, it's more like an insect, I should say, right? Where instead of constructing the trade this way, okay, we will use a call all the way on the top. We will use a put all the way in the bottom. So we have the same wings. But then in the middle, okay, in the middle, using the same strike, and this is what's the very, very big difference, okay? We sell a call and we sell a put, okay? That would be done somewhere in the middle, okay? Where we sell a call and then we sell a put, okay? More or less in the middle, halfway between the call and the put. The one on the left is called an iron butterfly. The one on the right is called an iron condor. The idea is similar, okay? So this is the lowest price of the stock, okay? Where the puts are. This is the highest price of the stock where the calls are. And basically what the options trader is betting, okay, is that the stock may either go up or down, but will remain in a range from now until expiration between the low price, okay, and the high price. And if that's the case, then the trader will make a profit. Okay. So if you were to look at a risk profile graph of an iron condor, it looks something like that. Something like that. Okay. So this is below the low price. Okay. So this is the low. Okay. I'll just use an L for low. This is the high price, right? So if this is the high price, okay, so this would be above the high. So if you are above the high or below the low, you lose. If you stay between, which is this area in here, okay, if you stay between, then you profit. Okay, that's an iron condor. The iron butterfly is the same story. You got the high, you got the low, and as long as you stay in between, you profit. Okay, but the shape of the graph is not flat on the top. The shape of the graph is more something like that. Okay, is more something like that. So in other words, as long as you stay somewhere between here, you profit. But the closer to the midpoint you are, which is where the short options are, the more you profit. The more on the side above or below you are, the less you profit. And of course, if it goes all the way above or it goes all the way below, then you lose a certain amount. Okay, like an iron condor. So it's the same thing, but it does have a different shape, and it has pros and cons and all sorts of different things, which is not the subject for the question. Okay, but basically, since we don't talk about iron butterflies often at all in the YouTube channel, I wanted to phrase it in today's session. Okay, so um, I used an iron butterfly using the 280, 290, 290, 300. Okay, so let me write this down. Okay, so the trader was using the 300 call and then sold the 290 call and sold the 290 put, and then purchased as a protection below the 280 put. Okay, so those were the trades. The two in the middle are the same strike, 290, so sell the call, sell the put, and then above buy the protection 300, below buy the protection 280. This created a credit of 873. Okay, so the most you can profit is 873. Now, for you to profit 873, okay, which I'm kind of jumping down all the way. So what I do not understand, where is the credit I should collect 873? Okay, so the only way to collect $873, which is your credit collected, the only way to make that profit in the trade is that on the expiration date and the very last moment before the market closes, the stock, Apple in your case, was exactly at 290, right there. Okay. If Apple is somewhere else, which is not 290, then you're gonna profit less, because remember the shape of the iron butterfly is like this. Okay. So 873 is all the way on the top. And all the way on the top lines up with all the way on the top lines up with 290, which is the strike you sold. Okay, so the only way to get your 873 is the stock expired at 290. That's the only way. Okay, that's the only way. Um, and by the way, as we go through this explanation, you will understand as well why in the YouTube channel I normally do iron condors and not iron butterflies. Because even though there are advantages of using butterflies and so many things can be done with options, you will see as well some of the problematic situations. Okay. Okay, so with this clear, let's continue reading. So I thought the stock will stay between 280 to 300, taking advantage of a supply zone at 303. Okay, so the trade was not on my favor. I was OTM. Okay, actually, I would like to rectify that. You were in the money, not out of the money. Okay, so you got a sign on the short call. Okay, so the stock that was somewhere in between at the beginning. Okay, so went up, 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 up. Okay, and because the stock went up, that 290 call where you were short, that being short a call gives you the obligation to sell the stock. Because you didn't own the stock, then you found yourself assigned, and therefore you were short shares. The day before expiration, as you explained here, which was May 7, 2020, which is the day before expiration, which is on the 8th. Okay. So am I saying right the date? Yes, I think so. Yeah. So that was on Thursday, 7th of May, which was the day before Friday, May 8th. Correct. So now, multiple things to be discussed here. I mean, to be honest, there are many things to be discussed based on your question. This is a very important question. So, first of all, how come you got a sign? Right? Well, you got a sign because the person you sold your call to, okay, you sold the 290 call. So someone bought the call from you, right? So that person decided to exercise the right. And this is something that options traders can do anytime during the cycle of an option. Now, this is not common to see an option being exercised or assigned prior to the expiration date. Why is that? Well, because the time value portion of the option is lost the moment the option is exercised. Okay, so if you are the option seller, okay, and you have sold the 290 call, and let's say you collected, I don't know, I'm just gonna make this up. Let's say you collected 110. Okay, so if you collected 110 and you had 1 week to go, okay, so that's the time value portion of the option, right? This is the extrinsic value portion of the option. Okay, 110. Let's say that day, okay, the person who bought the call from you decided to exercise. Okay, If they exercise, they get the stock delivered to them at 290. Okay, they get the stock delivered to them at 290. So let's say the stock went up to 293, right? And therefore, they have the right to buy the stock at 290, and the stock is currently trading at 293. So if they exercise the call, they basically get a $3 profit, right? They get a $3 profit because by exercising the call, they are giving up 110, but they are automatically collecting $3. So they end up with a net profit of $1.90, which is the difference. So some people may be tempted to do that. To be honest, only crazy people would do that, because giving up 110, which is what they pay for the option, means that in order for you to collect your profit, you are willing to give up on the whole profit of the option. To be honest, it would be way more easy to sell the option, right? So think about it. If the stock went up from 290 to 293, and you're still 1 week away from expiration, that option will not be 110 anymore. That option will be much higher value. So you can just go ahead and sell the call and make a profit, like if you own the stock without owning the stock, without giving up the time value. And therefore, it would be way smarter to sell the call and make a profit out of doing that. But there are some uneducated traders out there in the world that don't know that. They don't realize that by exercising the right and therefore getting you a sign, they don't understand that they would get you they would get to lose the time value portion of the option, and in their mind they get the stock at a cheaper price, and that's good enough, and they do it. So this is quite uncommon. This is really not a normal thing. If it happens like 1 week before expiration, it is really not a normal thing. But what about when time has passed and now you are 1 day away from expiration? Okay, so when you are 1 day away from expiration, no matter where the stock is, no matter if the stock is above or below or in the middle, the extrinsic value of the option, okay, is going to be much less. Maybe now it's 0.08. Okay, so what happens now? Well, now the person who wants to own the stock maybe have other reasons too. That, you know what, they just want to have it and that's it. And then maybe that stock pays dividends next week, or who knows what people are thinking. So now, even if they are educated, they may perceive, hey, wait a minute, if I get the stock by exercising my right, I only give up 8 cents. So now it's not a big deal. Let's exercise. And now you get a sign, okay, which is what happened to you on Thursday. Okay? So being assigned the day before expiration or a couple of days before expiration is not a weird thing. Especially if, and that's a big especially if the stock has moved a lot in the direction of the call. Or if it went down, you could be assigned on the put, same rule. Why? Because now the person who owns the call will be like, oh yeah, I'm only giving up 8 cents, but in exchange, I'm making all this money. I'm making like $15. So now 8 cents would be seen like, wow, that's not a problem. Let's exercise on Thursday. Maybe there will be profit taking on Friday, and who knows what's going to happen. Let's exercise on Friday, on Thursday. Let's get the shares. And if something happens on Friday, I'll just sell the stock. I don't know. No idea how people think, but that could certainly be valid thoughts for some, especially less educated traders, if you wish, with all respects. Okay. And what happens? In this case, you get a sign. And this is what happens to you. Okay. So you got a sign on the 290 call. And that was the beginning part of your problem, even though I would like you to realize that it is not necessarily a problem if you face it the right way. Why is it not a problem? Well, the reason why it's not a problem directly is because for you to collect those additional 8 cents, okay, let's face it, if you sold the 290 call at 110, the most you can make is 110 from that option, right? So if the only premium left is 8 cents, for you to make 8 cents, you need to wait another 1 day. I mean, how efficient is that? I mean, you made from 110 to 1008, okay? That is 1.02, if I'm not mistaken with the math. You made that in 6 days, right? You make that in 6 days. So in other words, just kind of like rounding in a very, imprecise manner. Let's say you are making like 20 cents a day, something like that. But now on the last day of the trade, for you to make the remaining 8 cents, now you need to wait another 1 full day. Okay, this is a normal thing with options. So they decay faster as time passes and expiration date approaches. But at the same time, especially when options are deeply in the money or deeply out of the money, so what happens, okay, and this one was a deeply in the money option, right? That's why you got assigned. Okay, you don't get assigned on out of the money, you get assigned on in the money. So because it was deeply in the money, the time value portion has shrunk so much, only 8 cents, that the time decay, mathematically speaking, is greater than the day before, because it's going to decay full 8 cents in one day to go to zero. But at the same time, the real P&L, the real benefit you get from that, it's very decreased compared to what you got days before. So one classical rule among options traders is when you sell an option and you see that option trading for 10 cents, 8 cents, 5 cents, you just close it. Don't wait until it's too close to zero to close it. Because for the option to be zero, it has to be expiration date. Okay? And that puts you at a greater risk of assignment. Second, efficiency. Okay, efficiency is kind of like killed, and therefore you will want to go out. Now, in this case, you never saw the option to be 8 cents because being in the money, okay, since let's say it went up to, I'm just gonna write down 305. So let's say Apple went up to 305. Okay, well, it was 303, you said. Okay, it's fine, it's okay. Let's say it was 305. So then the 290 call, you will look at the option chain and it would be at least $15. Okay, and let's say 8 cents of time value. So 15.08. So you will never see the short call. Okay, you will never see the short call to be such a low value option because it's deeply in the money. But you need to realize that all the value that is making up the value of that option is intrinsic value, not extrinsic value, because the stock went aggressively against you, and therefore the option is deeply in the money. Okay, but I bet you that if you had looked at the 290 put at this moment in time, the 290 put probably would be really, really, really cheap. Okay, probably 8 cents, 5 cents, 3 cents. And this would probably be an indication that there is no time left in the iron butterfly. So if you stick around, basically you are hoping, for the best, which is the stock to go back from 305 back close to 290, which I would say in one day it's unlikely, even though it could happen. And this is called being lucky, right? So, just keep that in mind. Okay. Anyway, there are more things for me to explain to you. Okay. This is, I'm still halfway into what I need to explain to do these things safely. Okay. So the trade was not on my favor. It was in the money. I got assigned the 290 call on Thursday 7 after hours, but the other options remain open. Okay. So what happened that day is that instead of the 290 call, that one is gone. Okay. That one is gone. And instead, you are long the 300 call, short the 290 put, long the 280 put, and on top of that, you now have a new position in your account, which is you are short 100 shares of that stock at 290. Okay, that was the new position, which again, if you think about the theory behind options trading, risk profile graphs, and you think about it all on the expiration date, that would be 100% equivalent. In other words, you collected your 8 cents without having to wait for expiration date. You ended up with the same thing you would have on expiration date without having to wait for expiration date. So that's why I said it's not necessarily bad, even though what ended up happening to you is quite bad. So we need to talk about it more in depth, okay? So my mistake, I got panicked and I sold all my remaining option using a market order. So this is something that I need to discuss intensively, okay? I sold profitable long call, and the net result in the end was negative 1,397, where actually the loss should have been 127 only. But if I let the remaining options expire, I will make money on the long call, 300. So what I don't understand is where is the credit? I should collect A73. Okay. So, and I mean, you collected the credit, okay? It's just that the prices that you paid to close the long call and the long put, and sorry, the prices that you paid to close the short put and the prices you collected from the long put and long call gave you that net P&L of 1,397. And where is this coming from? How come we have such a massive, massive, massive distortion? Well, there are two reasons for that. The major reason is what I pointed here at the fact that you use market orders. This is the reason for your trouble, 100%. And by the way, it is not uncommon. It is absolutely common that if you ever try, and by the way, Apple is a liquid stock, okay? So it's not like you were dealing with a naughty stock that you were playing with, okay? You were dealing with a proper stock, proper option chain, proper everything. So how come you got just like so crazily slipped, okay? Well, because on the expiration date, the options that are deeply in the money and the options that are deeply out of the money, you will see on the option chain very, very commonly that there is no bid or there is no ask, or the bid is 1 cent and the ask is $2, or the ask is 1 cent and there is no bid, or crazy stuff like that. Okay. In other words, the only options open on expiration date that are far in the money or far out of the money, it's because the traders that put those trades in didn't manage those trades during the life of the trade, waited all the way to the expiration date, and now they are in trouble. Market makers know that. So what do they do in those particular situations? They just widen the spread all the way. There is no bid, or the bid is 1 cent. So you may be able to sell the 280 put, but you only get 1 cent or nothing, right? Or you may be able to sell the 300 call, but even though you will get the intrinsic value, that's fair. But when it comes to the time value portion of the option prior to the expiration is not going to be priced correctly, because the differences between the bid and the ask price. And again, what you will see in the option chain is equivalent to not getting the intrinsic value like you should. So for example, the 290 call, when the stock is trading at 305, should have a value on expiration of at least $15. Okay, at least $15. But what's the problem? On the ask side, okay, on the ask side, the sellers, which is you will see $15. But on the buy side, which is the buyers, okay, which in this case is going to be the market makers, you will not see $15. You may see $8. You may see $2. Some crazy thing like that. Why? Because why would someone buy an option that is about to expire in a few minutes or a few hours? Okay. So again, this is the problem you had. When you use the market order, your trading platform, which is what a market order is supposed to do, your trading platform just matched the bid price when you sold and the ask price when you bought. And because the bid and the ask prices were so far away, because of what you just explained, you just got completely hurt, really, really badly hurt on this trade because of that situation. So in that situation, the best thing you could do, okay, and I'm gonna tell you two things important here for you to remember. The best thing you could do in this type of situation is to wait until the whole thing expires, because the moment the whole thing expires, okay, what you would have seen is the following. So before expiration, you are short the 200. You are short 100 shares at 290. Assuming the stock is above 305, then the 300 call would automatically be exercised on expiration. So in other words, you were short at 290, you will be out of the trade at 300, okay? So you will lose what was expected on the upper side, okay? The 290 put would expire at 0 and you would collect the whole premium. The 280 put would expire at 0, you would collect the whole premium. So all the premium collected here plus the premium collected here will be kept as yours, and then you will get this amount of pain, right? So that would have given you exactly that P&L. Okay, this is what would have happened to you. You would have got exactly that P&L if you had let everything expire by itself. Or maybe you can get an improvement of this P&L, okay, by instead of using market orders when you try to close it, use limit orders. Use limit orders and set the prices you want, and be patient throughout the last day of the trade, and hopefully you get filled. Okay, which it happens from time to time. Not so often, but it does happen that with limit orders you get your prices. Especially if the market was to move violently at some point, that may create a little bit of a spike of volatility, and next thing you know, you get filled on trades. Okay, and with the limit orders, because market makers adjust the spreads, and next thing you know, you get filled. And now you exit at a proper price, so you may have a little bit of improvement over that. Okay, and if that's the case, okay, and you get a little bit of improvement and you can exit the call at a good price, and then you were short stock and the stock went down a little bit, so you may end up minimizing the pain, and instead of 127, maybe you lose 100. Okay, that could happen, but that's very difficult to do, to be honest. So when you get into this situation, probably the easiest way to approach it is leave it alone, unless you have problems with margin, which is what happens to many traders doing iron butterflies. You got big problems with margins, and if you leave the trade open, you're going to get a margin call, and therefore some traders have to close it. Okay, so but again, the use of market orders are really, really going to kill you. Okay, so this is one thing for you to keep in mind. Okay, the market orders are going to be very, very problematic in this type of situations. Okay, you have to be a very experienced options trader to deal with this and try to minimize the problem instead of getting into a bigger trouble. Okay, now I said I was going to give you two options, okay, on how to deal with that situation. Okay, and the second option, I want you to understand why is it that most of the trades that we do in the YouTube channel are iron condors instead of iron butterflies. Okay, because you will see, I'm gonna type this again. Okay, so this is an iron condor. Okay, and this is an iron butterfly. Okay, so selling the call and selling the put at the same strike. Okay, so you got the iron condor and the iron butterfly. Okay, so now with the iron condor, for me as a trader to be in the same problematic situation you've been, in other words, for me to be assigned on the call or to be assigned on the put. I'll talk about the call because it's your case, but the put is the mirror image, so it would be the same thing. So then, let's say I started the trade somewhere in the middle. For me to be in that problem, okay, I would need the stock to move and travel by that amount, and now I am subject of being assigned. Okay, but now if I look at the iron butterfly and I start here, for me to be subject of assignment, I only need the stock to travel by this amount. Just that amount makes the call to be in the money. For this call, for the call on the right to be in the money, you need the stock to travel by that amount. Okay, so again, you are giving yourself greater, how do I put it? You're giving yourself greater room for protection in the sense of less risk of being assigned. What's the other difference? If I am assigned on this call, my protective call is very close by. So this may be 300 and this may be 301. So if I get assigned on this and the stock keeps going, I'm very soon going to get protection, and then I have peace of mind, and I can wait until the whole thing expires if I want to leave it like that and get my theoretical loss, and that's it. Okay, we're here for you to gain protection. Okay, the stock has to travel all the way there, which it did in your case, but you will have many cases with iron butterflies when they go well, where the stock is still here and the options expire. So what's going to happen? What's going to happen is that this expires, but it's not in the money. So it does not exercise. Okay. But this call is in the money, so you are assigned. Okay, so assign means that on Monday you look at your account and you have short shares with no protection. And this is when the iron butterfly goes well. Everything was exited somewhere in the middle, but now on Monday you have short shares, and if the market was to open gapping down, great, because now you make a profit on the shares. But what if the market opens gapping up? Now you get an additional pain for the short call that became short shares when you got assigned, you know, because price was above the call strike on expiration date. So it's difficult to manage. Okay, could that happen with the iron condor? Yes. Okay, price will need to stay somewhere in between 300 and 301. That would be the same story, because you would be assigned on the 300, you would not have protection with the 301 on Monday. So it would be the same story. Okay, so what is a good rule? Okay, what is a good rule? I want to summarize this with two good rules. So, good rule number one: don't use market orders to enter or exit options trades. Don't do it. Okay, and if you do it, only to enter, but not to exit. Okay, this is one of the reasons as well. We talked about this in the channel in multiple opportunities, where we talked about why is it that I prefer to use options when I do directional trades and maybe I buy a call. Why is it that I prefer to buy a call with no stops, knowing that the most I can lose is what I pay for the call? Why is it that I prefer to do that instead of buy the call and use stops? Okay, and the reason why, it's because if I use a stop, it will be a stop market order. So when I exit the call with a stop, I will get slippage. Now, when we do directional trades, we use options that expire, 40, 60 days from now, 70, it depends on the time to target, right? We have a process for that. Okay, well, in other words, even if I get stopped out with a stop market order on a long call, I will be stopped out with a market order, I will get slippage, but at least my option is not likely to expire today. Because if I bought an option which is like 60 days to go and then I get stopped out 5 days later, I still got 55 days to expiration. So I'm not going to have this very, problematic approach of market makers, which I described before, right? But if you use market orders on options contract that expired today, wow, you see what happens. Okay, it's very problematic because market makers take full advantage of that problematic situation. Okay, so we need to be well aware of that. So rule number one: don't use market orders. Rule number two, okay, rule number two, don't wait until the expiration day to close your trades. Okay, don't wait until the expiration date to close your trades. Okay, for sure, using limit orders, but don't wait until that. Okay? Exit before. Exit before. If a market is moving too much against you, and it goes, you have UFOs, and price goes above, and you're hoping it's gonna come back, Well, yeah, probably not. Okay, could it be? Yes, probably not. That's why it's going through UFOs. Maybe the climate is different. It's against you. So again, don't hope. If you expected a trade to act in a certain fashion and it's not the case, instead of stay hoping, plan on closing the trade ahead of time. We also talked about how to enter, damage control mode, where you can reconvert, for example, an iron condor into a butterfly. You could take a butterfly and do something else with it, isn't it? Again, this is not the day for us to talk about this, but if this was your butterfly, you buy a call, you sell a put, and then you buy a put. Okay, that was your butterfly. So if you get a sign on this one, okay, that means that this one will have very little value left and this one even less. So maybe what you could do now is close this, Okay, you close this. Okay, and maybe you kind of you redo something different. Okay, so maybe you enter. Sorry for that. Maybe you enter a short call on top of the call you sold. Okay, and then you enter a short put at a higher value if you got UFOs that justify that with a protection. Okay, and now basically you have a new credit spread. Okay, that pays for a debit spread, and now probably you will end up with a similar P&L if everything goes badly. But if it keeps going like majorly, this will pay more than the pain you got, and this will create another profit, and you may save the trade and you end up with a little bit of a profit. Okay, but again, this is now getting very original, just to show you things that you could do. But by the way, all those things you can only do if you acted soon enough, and that is before the expiration date. On the expiration date, it's when market makers take advantage of traders, because it's basically desperation mode to try to fix something that is difficult to fix now. Okay. Okay. Very long answer, my friend. Very long answer, but again, it was a very important question. I know it was a big problem for you. It's also a good lesson. This, believe it or not, this happened to all options traders in the world. I've been in that situation myself. Okay, so this is how we realize the what to do and the know what to, and the not what to do. Okay, and also one more comment I would like to add here is, if you ever find yourself tempted to trade or practice a new option strategy you have not traded before, if that's your case, make sure you use it for a while in paper money. And once you are confident that you really know what you're doing and you have observed those option chains closely, especially on the expiration date, and you know exactly what to expect, then you move into live capital. Okay, don't start trading live capital with complex strategies too soon, because as you can see, there are many moving parts. Okay. Ahmed, but if the price is between the call and the plus call, I am making dollars from the trade. I should close the trade before it closed to expiration. Yeah, if you are between the range and time enough has passed and options have not inflated significantly, you should be profitable between the long strikes, between the call above and the put below. You should, anywhere in between, you should be profitable. But the only way to get the full 873 is to be exactly in the middle, exactly on the expiration date. Okay, which is never going to happen to get the full 873. Marcus, import the scans in Treasury 9.5. Unfortunately, I cannot, because I have 10 right now. I cannot run 9.5, but it's the same process. If you receive the files and the steps, it's basically the same thing. You just need to go and restore. So the import is really not an import; it's a restoring process. Okay, so a few more questions I think I missed. Mark, maybe the person mixed up us 5A with British 8.5. Yes, well, we are a diverse group here, Mark, and really only in the US you guys put the month in front, which makes a lot of sense if you were to put the year in front too, isn't it? So year, month, and day, but month, day, and year, it's kind of interesting for people that we've been born in other parts of the world. Just joking. Okay, Bahash, do you want to stay another 24 hours for 8 cents? No, absolutely not. That was the point, isn't it? Short 100 shares of Apple shares would hurt so much. Yeah. If there is no protection, yes. If there is no protection and the stock goes against you, yeah. Good. Very important question. Okay, so now let's go ahead and take a look at some stocks from the Indonesian market, isn't it? So how would you trade stocks from the Indonesia market? To be honest, the answer to this question is you would trade stocks from the Indonesia market the same way you trade stocks from other markets. The only difference is that the rules are different, and in this case, the rules provide certain limitations. Okay, so I'm just going to load Uh, PGAS, okay? Stocks from Indonesia. Here we got. So we got Perusahaan Gas Negara. Okay, so we're gonna load this particular stock. Okay, and here we go. Okay, so how would you trade this stock? Oh, wait a minute. I need to validate. Okay, so it seems that I need to get data from the Indonesian exchange. 1 second, guys. I thought I had this activated. Maybe they have done an update recently. 1 second, guys. I'm dealing with this on my other computer screen, so I can do it quickly. So worldwide. Yeah, I have it. I have it. I don't know why I got this message. Let me try again. Oh, maybe it's because I'm connected with TradeStation here below. So maybe it's confusing the platform. Let me move to paper trading and let's do it again. So the symbol was PGAS stocks. Okay, yeah. So I guess that was the reason why the platform got slightly confused. Okay, so here is PGAS. Okay, and here we got a stock. Okay, and when you look at the climate, okay, you can see the climate is confirmed. Okay, so again, one of the limitations on the Indonesian exchanges is that you cannot short; it's not allowed. You can only go long. So in this sense, you will need to look for stocks that are in an up climate. Okay. Notice as well, I'm using the daily time frame. That will be my starting point. Certainly not below that. And the reason why, let me show you. If you look at the 55-minute time frame, what do you see? You see a lot of market data that represents a lack of liquidity. Okay, in other words, another way to say that is the Indonesian market. It's not a very large market. It's certainly a market where opportunities are available, but it's not a large market. So liquidity will be problematic at times. And when liquidity is problematic at times, liquidity means less orders, and less orders means less on-field orders. And so using lower time frames would be problematic. So certainly I would recommend to use the daily time frame as a minimum, and certainly even better use weeklies and monthlies to set the climate and trade larger time frames. Okay, so let's give it a try to see if we can find a trade on this particular stock. Okay, where statistics suggest, well, actually that one would be a no, because statistics suggest that when it goes up, it should be 5. 441 is 5, and the current is 5 already. So it's been moving already by 5. And in other words, we can see it here. Okay, and in other words, statistics suggest it may have a change of climate anytime soon. Okay, so when that's the case, then you could change to the weekly, which in this case is red color. So then you cannot trade, or monthly, which in this case is red color. So you cannot trade. It's that simple, because the Indonesian markets don't allow to trade up climates, and I'm not gonna make up what is not. If it's a down climate, it's a down climate. That's it. Okay. So the next one I'm gonna check is PTBA. So here's PTBA. Okay. And again, in the daily time frame, you can see major move up. Okay, that one could be interesting because the climate suggests 1. Okay, so 1, where statistics is 6. Okay, so you may get into a trade here for 6 days. Okay, the average price is 18.95. Okay, so now that you know this in the daily time frame, you will want to look at the 55-minute time frame, turn on AutoUFOs. Okay, the algo with AutoUFOs is quite complex, filtering out for all those different parameters of liquidity. And guess what? Beautiful. We have this UFO right here, 1910, to 1855, this is enveloping nicely 1895, right? 1895 is somewhere here in between, right? So that's your UFO, okay? So your entry would be 1910, and now the target. So I'm turning on Auto UFO on the daily time frame, and here's where your target would be 2420. So if you were to take a trade on this particular stock, well, I cannot enter it there because it's not tradable on the paper money account. But if I was to write it down very simplistically, so I would just make a note and I would say that the final target is 2420. We will have a safety target which we need to define. We would have a long entry which is going to be the green UFO at 1910. We would have a stop loss which is going to be below 1855. Okay, and again, this is where experience comes into place, and I don't have much experience with the Indonesian markets. Okay, so you will need to look at what's average volatility and things like that. But maybe I would say that maybe if you put it like 10 points below, something like that, so 1845, something like that, that may do. Okay, again, little bit of a question mark there, given the fact that I have limited experience with the Indonesian market. Okay, but anyway, so from 45 to 10, we are dealing with how much? 75, right? So that means that your safety target will be 1985. Okay, so entry 1910, safety target 1985, stop loss 1845, and finally final target 2420. Okay, and it's looking certainly a neat trade to take, and you can certainly approach it like you would approach anything else. Like always, and the same happens to the US markets compared to the Indonesian markets, same story. Stocks are a fragile asset. Okay, so ideally, because options are not that available in the Indonesian markets with levels of liquidity that are convenient enough, normally you would want to take the trade with shares and that's it. So in that sense, you could find yourself stopped out and then see the stock go your way because maybe the Indonesian exchanges, the Indonesian indexes are, just moving in that direction or whatever, or the sector of that stock. So I would recommend, and again, this has to do with experience, that you watch closely the sector of this company, other stocks related to this company. You also watch the Indonesian exchange as well. And ideally, when that stock is coming down and down and down and down and enters that UFO, which is the UFO you want, you see the Indonesian index enter its own UFO too, and that's when you trigger the trade manually. So in other words, instead of triggering the trade automatically by placing a limit order at 1910, which is what we would do with Forex, futures, etc., so probably it's going to be a much better outcome for you to wait for this to happen, and when price comes here, then begin watching the indexes, wait for the indexes to come to their UFO, and when that's the case, then do a manual buy order at that time, so you get filled, knowing that not only the stock has unfilled orders, but also the Indonesian market as a whole has unfilled orders to buy. That would increase your probability of success. Okay, so that's how you would do it. It's not that different, to be honest, isn't it, Agus? Okay. Marcus, do you have experience with the crypto market and the UFOs? Yeah, and I would just make the same comment I made when it comes to the Indonesian markets. It's not a liquid market, but it is a market. And if you apply the UFOs, I mean, you will see things working. Okay, so it's like everything else. If you get your Bitcoin US dollar, for example. Okay, again, what happens in the 21-minute time frame? Look at those very ugly candles. Okay, so lots of lack of liquidity. Even the 55. Okay, so with the cryptos, really, it's much better to stay in much higher time frames. Okay, much higher time frames. And also, let's face it, you cannot short cryptos either. So should be subject of long-term investments more than little intraday gambles, hoping for the best, isn't it? Wonderful. Thank you, Agus. Yes, 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 of course. My pleasure. Okay, so my friends, last question for the day, and we'll call it a day. Uh, so how can I do backtest the strategy if in TradeStation I don't have the replay mode for the auto climate feature in the screen? How can I apply the time stop in Forex? What is the winning ratio in Jose experience in the Forex to the safety target? Thank you for this is my biggest questions for the live course that I will attend at the end of May. Can you tell me if the instructor will cover how to manage the trade, etc.? Okay, so there are multiple questions here. There are probably all easy and quick to answer, so I'll go for it. Okay, I'll just have a little sip of water if you don't mind. Thank you for that. I really needed that. Anyway, so how to backtest with TradeStation? Okay, well, it's a problem because as you said yourself, TradeStation does not have a backtest functionality. Okay, so the most you can do with TradeStation is to go into daily timeframes. Okay, daily timeframes. What did I just do? I'm not sure I did daily. Here we go. Here's the daily time frame. Okay, and so let's say you want to backtest what has been happening recently. So then you can just double click on the candles, change the date manually, and say, hey, my last date was May 2. Okay, and then you click OK, and it loads until May 2. And now it's like, okay, so what happens next? So let's see May 3. Okay, and you go up arrow. Well, that was June. Sorry for that. You go up arrow May 3. Then click OK, and then it shows you the next candle. Probably May 3 was the weekend. Yeah. So May 4. Okay. So May 4, 1, 2, 3, and now we gotta move, right? May 5. What happened in May 5, right? And you just keep changing it this way one at a time. And you could do some backtest, okay? But as you can see, it's very manual. It's quite tedious, okay? And it only can be done with the daily time frame because there is no such feature in TradeStation, okay? So yeah, the best way to do backtest is TradingView. Yeah, and there is no, yeah, so in TradeStation, there is no backtest, and therefore this applies to the charts, and it also applies to Red Screen, okay? There is no backtest in any of the places. How can I apply the time stop in Forex? Okay, so the rule for time stop in Forex is the same. So you would take a trade, okay, for example, on the euro, okay, and let's say you're using the 60 and the 8, okay, so your time stop methodology depends on your edge time frame, which is 8, okay, and then the rule says to use anywhere between 3 to 5 candles, okay, that is the rule. I know that some of you have been backtesting other variations and decided to implement other variations. That is fine too. I remember one of you sent an email once and said, hey, Jose, I also love Fib numbers and I've been backtesting 8 candles, which is also a Fibonacci number, and I like the result better, so I'm using 8. It's fine. The whole rationale about the time stop is if the climate is in your favor, the EMA is there ready to add on-field orders, you also have a UFO, meaning on-field dollars are already available in the market. I mean, if all of the above is true, the price should move in your direction fairly quickly. But if it doesn't, that probably means that the on-field dollars are being filled, about to be fully consumed, or the climate is about to change or in the process of changing, and all of this together puts you in a bad position. So get out. So how do you know that? Well, a mechanical way on how to basically take this into consideration is to use a time stop. Okay, so 3, 5, 8 is fine. Not using time stops is fine too. Okay, using time stops will probably make you safer, but will also have you miss a few trades. Okay, so it's all about how conservative or aggressive you are. If you are very aggressive and you don't want to miss trades and you don't care about risk, don't use time stops. If you are a bit conservative, just a little bit, okay, and you're okay from time to time to miss a trade, but you really don't like this to happen too often, then use 8 as your time stop, or 5. And if you are really impacted by emotions and you really get, now let's call it a bad mood if you get stopped out. So one way to minimize it is to use 3. Okay, it's going to make you more conservative. Okay, the lower the number, the more conservative. The price to pay, though, is that sometimes you'll have a time stop trigger, you're out. But then 10 minutes later, the trade will take off and you miss the move because you're out. Okay, so depending on your personality profile as a trader, you will want to decide what's best for you. Okay, because really there is no black or white answer to this question. It has to do with you, the trader. Time stop rules have to do with managing human emotions. Okay, it's nothing to do with the methodology. It's managing the human in us more than managing the markets. Okay. What is the winning ratio in Jose experience in Forex to the safety target? That is obviously a very important question. It's also very difficult to answer with one figure because the real answer is it depends. It depends through time because there are times where markets are easier to trade and times where markets are crazier to trade, meaning there are times where climate just keep propagating. It's just so neat and clean. And there are times where the markets are very choppy. So when the markets are very choppy, it's more difficult to trade. So winning ratios change through time. And the other reason why it varies is because it depends on the time frames that you use. It's not the same to use an 8-minute time frame for each time frame compared to using a 144-minute time frame for each time frame. The person using a higher time frame would normally benefit from a much stronger climate and therefore would probably benefit from a higher winning ratio, where the person using a lower time frame does benefit from a closer safety target, but at the same time also a weaker climate. Okay, and that's how it is, So it's difficult. So what I want to do is give you a range. Okay, so you could expect the range to be between 55% to 65 to 70%, something like that. Let's call it 55 to 70, depending on times, depending on time frames, etc. And to be honest, there are many what ifs. Are you merging UFOs? Are you not merging UFOs? Are you trading at the beginning of the climate, in the middle of the climate, at the end of the climate? So all those things have impacts. Okay, all those things have impacts. And the time of the day at which you trade, there are so many different moving pieces that impact. But as a reference guide, if you wish, maybe you want to think of 55%. That may be a good way to think about it, even though it could be more depending on other parameters. Okay. And then for the live course that I will attend at the end of May. Okay, so I guess you are talking about this course. Okay, the Survival to Mastery Forex in Action, 25 to 29 of May. Okay, so I believe that's the course you're talking about. So can you tell me if the instructor will cover how to manage a trade? The answer is yes, to a certain degree. Okay, that course is a very powerful course, and I would love all of you to take that course. And when you join me in the YouTube channel, that all of you 100% have taken the course, either live or self-paced on our website, because that way we 100% speak the same language. Okay, so I would really love it. I understand that it's not possible for everybody, and some of you are busy and stuff, and everybody's at a different situation in life, and it's fine. But at the same time, you need to know that this course is designed to be a complete course on how to trade in one hand. At the same time, it's still a foundational course. So it will teach things that are extremely relevant to how trading should be performed. But it's 3 hours a day, 5 days. So it's 15 hours total. So there is so much you can fit in 15 hours. In other words, after you complete the course and you spend more time with us here in the YouTube channel, this is where we talk about trade management to a deeper level. Okay, you may have seen, and some of you, by the way, feel free to comment on the chat box. Okay, because some of you here today have taken the course before, isn't it? So you have seen that in the YouTube channel, we use this flowchart. And you can see that when it comes to trade management, we got 1, 2, 3, 4, 5, 6, 7 options. Okay, and we have conducted sharpening sessions, which are recorded, which, by the way, you can go and watch. where we talk about trade management, the flow chart, and all those different possibilities. Okay. Well, in the course that will run at the end of May, this one, the time stop, which is optional, will not be covered. This one, the too far too fast, which is optional, will not be covered. And this one, the UFO trailing exit, that is optional, will not be covered. So in other words, you will have three items left in the course, because again, the purpose of the course is to build that very strong foundation, get you prepared, be understanding of you guys being busy people. Most of you have a job, have families, have responsibilities, and we cannot do like 10 hours a day, 20 days. That would be great, but that would be a utopia. Okay, it's not doable. So what we do is in the course we talk about what's really 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 important and you need to master 100%. Yes, and then in the YouTube channel we keep working on developing you and helping you to go to the next level. Okay, so not sure if there is anything left. Not sure if there is anything left. Let me take a look at the chat box. Yes, Jaime, I did not forget. Osman, what would the edge time frame for 2 hours and 3 hours if you got time? We don't have an edge time frame for that. Okay, if you look at the time frames that we have, the 2 hour and the 3 hour climate are not part of it, because 2 hours and 3 hours are not common time frames. And the whole point, I mean, like talking about the course, for example, we talk about why do we use certain common time frames and why don't we use other time frames. So yeah, so it would, I'm not saying it's crazy to think of 2 hours and 3 hours for climate. I'm just saying it puts you at a disadvantage from the point of view of why we want to use common timeframes. Okay. Yes, Marcus, absolutely. You will have replay mode and UFOs showing up and disappearing, in past market data that you can play at your own pace. Okay, emulating real-time market data. UFOs are created and UFOs are traded or removed. By the way, Marcus, I don't know if you have checked already, but check your email because we did send an email concerning the recording from the last week class. And there is something there that may interest you as well to get those UFOs working for you. Ahmed, I noticed the stop orders will be better if behind the EMA 20. Yes, it makes sense. Okay, the only problem of that is that many times the stop would be far when that's the case. But it makes sense. The more the EMS between your entry and your stop, the better. Because remember, each EMA, not only the 9, each EMA, including the 20 for sure, is a source of potential on-field orders to be added. So if your stop was to be in the other side of all the EMS available, that would be the perfect location for the stop. That would be too far. So it seems that you are finding success using the 20. Great. Okay, absolutely great. Thank you for that, Ahmed. Appreciate. Osman, can you use one time frame for executing trade? I'm not sure I understand your question, Osman. I'm sorry. Can you use one time frame for executing trade? That would be the edge time frame. Yeah. Okay. So it seems that we're going to conclude the session here. Osman, I'm not fully getting the meaning of your question here. So if you want to send an email to us and maybe you take a couple of screenshots or something, we'll be more than happy to take a look. Anyway, everybody, so this is the end of the session. As always, thank you very much for joining me. Weekend time, Sunday time, and super appreciated that you guys make time for me and you come and join me. Obviously, we have a reason to do this unit. We have the same passion, which is the market. So I also want to certainly congratulate you for always showing that commitment and that hard work, finding time either during the week time or the weekend, or watching this recorded, which may be your case if you're watching this recorded. So keep up the good work. This is the key, and count on us. Any question, shoot emails. If it's easy, we'll respond via emails. If it's not so easy, then we'll keep it in mind for the next sharpening session. But again, keep up the good work and see you soon, everybody. You guys take care and stay safe out there, okay? Bye bye, everybody. See you soon.